We hope you had a very pleasant lunch. We're now going to commence with our continuing presentations. Angel investor based in London, United Kingdom, member of European Changer Club. Sergio Aman with 15 plus years of experience in financial services industry, working for large corporates including Goldman Sachs, Accenture and Citi. Sergio had the unique experience of working for a fintech startup and growing the firm from 10 FTE to 60 FTE. Now an avid angel investor, he has exited some of his investments with 5 times return and is currently invested in fintech and in medtech startups. Ladies and gentlemen, Mr. Sergio Aman.
Right, hello everyone. Let me see if I can get this. Right, so I have the tough job of, having a sleepy audience after lunch, and I guess I have to somehow wake everyone up. And what I'm going to talk about is the changing investment landscape. And I think money never sleeps, so hopefully that should be a good way to get you all interested. What am I going to do? I'm going to talk about 3 things primarily, and hopefully leave time for one question in the end. I'll give you the macro picture around investments right now, what the current market environment is for venture funding, and then share my tips as an angel investor, what we or I look for, and how can founders change their fundraising approach. And I'll try to do this in a timely fashion. So hopefully we will have some time in the end for questions. Right, first thing first, the macro picture. So what I'm going to do, the way this is going to work is I'm going to make you all, as startup founders, really depressed, and then hopefully give you some hope in the end as to how you can change your approach when you look for funding from investors. What is it that investors are looking for? So on this slide here, I have taken that from Macro Hive. A good friend of mine, Bilal Hafiz, he is the CEO of Macro Hive, and you may have heard of him or seen him on Bloomberg a lot of times. This is his recommendation as of 15th of March of asset allocation, right? So this is, as investors, what are we looking for? We want to increase our money, right? And we definitely do not want to lose it, right? And I know you may think that that's a very, materialistic, capitalistic view of the world, but if I have to do charity, I'll go to a charity. Investing is for increasing my investment. Now, the challenge we have, the macro environment, this is not me, the experts are saying the cash is safe, cash is king. They are almost saying commodities, prices are going down, equities, they're underweight, bonds, they're underweight, cash, big overweight. So the sad news for you as startup founders is that people are reluctant to spend lots of money. Things have changed. 2021 was a great year for startup funding and investing. I exited one of my investments I made in a payments platform within 3 years and got 5x, i.e. 500% of return. But things are different now, and I am seeing that with many other investors, people in investor relations. They're saying venture capital funding has dried up, and you're seeing bank crashes essentially happening. The banking crisis, Silicon Valley Bank was primarily focused on venture capital firms. So things are tight. Now, why are they tight? So, current market environment for venture funding. So, as you saw in the previous slide, the advice to investors is cash is king. And you can now get a much better return on cash than compared to the last 15 years. Since the financial crisis, I had to put my money to use because staying in the bank, I would get like, I don't know, 0.05% or 0.5% return. Now, with the interest rates rising up to 4.25%, at least in Bank of England, I can get some money and it's safe. My money is safe because I can get it out whenever I want to get it out. We have significant volatility in the equity markets. So equity markets being publicly listed companies, there is significant volatility. In fact, I'll give you one example. Everybody knows of Tesla. Tesla, I think around April last year, was worth $1 trillion. And it almost lost 60% of its market cap by October. So you have a Tesla, I mean, Elon Musk was the world's richest man, and $600 billion was wiped out due to market volatility. And now they've gained that back, actually. They've gained a significant portion of it. But that's, equity volatility is making investors nervous. From a startup perspective, that means IPOs are, not have the volume has reduced. So that adds to the nervousness of an investor. Crypto is a competitor. Now I know many of you would be thinking crypto, and in fact, if I was to look at some of the FCA advice, SEC advice, they're all saying, crypto is dangerous. Don't invest in crypto. Crypto is extremely volatile. However, if you bought Bitcoin at $16,000 and now it's at $28,000, you've almost doubled your money within 4 months. It's not a bad investment. And what starts happening is that crypto is almost being seen as a venture capital alternative because venture capital is risky as well. It offers, venture capital, your money is locked in for a longer period of time. Crypto, there's liquidity. But with all things, there are risks, and similarly, there is risk in crypto as well. And this is not me trying to say go down the crypto route. But I'm just trying to highlight to all of you that raising funds now is a lot harder than it was last year at this time, or than it was 2 years ago. And the trend, personally, I think will continue for another 12 months until we see this massive crash everybody is waiting for. Generally, economic cycles are like 10 years long, but it's been 15 years since we've officially had a recession. So everybody is waiting, seems to be waiting for some big crash. Right, now hopefully I have been successful in depressing all of you who are looking for some funding and saying that there is less cash around. But hope is here. How can founders change their fundraising approach? Okay, so I have 5 bullets here, 5 areas which hopefully you can take as takeaways, and I'll try and spend reasonable amount of time on all of them. The first one, David and Goliath, and I'm sure many of you may know of the David and Goliath story. There's a book by Malcolm Gladwell who talks about the story as something where David being small was his advantage. Your weakness, which you think is a weakness, can be your advantage. Let me make it more specific to startups. Right, so if you are a female founder and you're thinking, oh my God, in this world of men, how will I succeed? But actually, that is your advantage. I cannot be the female founder and say, hey, please can I get for lots of money for women in tech? I'll probably go to my friend and say, would you want to be a founder, right? So, and same goes, in fact, many of the companies I've applied to, see whatever, be confident in what you are, find the similarities. I live in North London. North London has a significant Jewish population. That's my common point for engaging with that stratosphere. I see lots of people from Asian heritage here. You should be going to essentially rich investors, people who have money from that background, because people somehow feel more comfortable with when they see similarities. And I know this may sound like a very controversial thing to say so, but use the unconscious bias to your advantage. If that gets you money, if that keeps your business running, then that's great, right? You've achieved what your startup funding requirements were. So, just highlighting again the David and Goliath story. If anybody's into reading books, check out Malcolm Gladwell's book. It really highlights that you can use your disadvantage as your advantage, because that is your unique point. Right, the next one. Now I know you must be thinking the wording here is slightly controversial for House of Lords, but it goes back to a political environment. So I've written for those there who can't see the screen, it says, it's the revenue stupid. And I use the word stupid because Bill Clinton, post the Gulf War in the 90s, he had this was almost his election campaign, where he said, it's the economy stupid. And he won the elections instead of, where George Senior Bush was focusing on the Gulf War. Bill Clinton focused on the economy, and that became his slogan, it's the economy stupid. Now, as startup, and I'm going to be, I think, politely highlight for your investors or for your pitch decks, talk about revenue. We are now in an environment where money is less and investors are trying to focus on where do we get to revenue. You can tell me a great story, but if people are not willing, it could be a great platform, great software, but if people are not willing to pay for it, if you don't have a sustainable business from a revenue perspective, then that is not a good investment in current times. Gone are the days where we were talking about, hey, I've got, 50,000 active users, and I'm charging them $0, and I'll run a loss for another, 6 years, and then maybe I might be profitable. So revenue is really important. And so in your pitch decks, I would recommend talking about revenue. If you don't have it now, show the journey to the revenue. When will you be in a position? Talk about sort of not just daily rates or, hey, my per customer, I'll earn X amount. Talk about I'm asking for $500,000 and I expect within 6 months to get $250,000 revenue generated. So suddenly people are able to compare the investment amount with the revenue, because the choice the investor has is keep that cash safe or invest in your business, which will hopefully multiply because you can generate revenue. Some things to other things. Know a monthly burn rate. I asked this very as an investor to people pitching to say, okay, you're asking for. In fact, this was a specific investment. They were looking for I think £500,000, and they said, okay, but their burn rate was 90,000 or 80,000 pounds. I said, you'll run out of this money within 6 months. What is the strategy after that? So knowing the burn rate, how quickly we will get to a sustainable valuation, sustainable business. All of these things are very important. So that, from an investor point of view, focusing on the numbers, revenue, costs, it's very simple, if I may say so. I think I find venture investing easier than investing in listed company because, evaluating the financials and audit firms, that's quite complicated. But here you're trusting in the founder, of course, and some relatively simple numbers. Number 3, know your investor. So, what happens mostly at times is founders go and pitch to everyone, right? So they don't know, so they hear the word, oh, there is an investor there, and they start pitching. Don't waste your time. Try and understand what is it the investor is looking for. What sort of time frame they have for exit. Would you be able to provide that exit? Because what you don't want to do is give them false hopes. And investors are actually, they get presented a lot, so they're very quick in figuring out that this is a false hope, this person is not going to give me the returns they are suggesting. So know your investor, and in fact, asking questions like, there's a famous sales story that, can you sell me this pen? And the answer, it's not just apply standard sales strategy, it's to know what is it that the other person is looking for. If the other person is looking for a quick return, if they're looking for 10x, they're looking for 5x, how are you going to achieve their objectives? Especially on the sort of institutional side of things, they may have some ESG goals. I mean, we have a war going on in Ukraine. There may be some investors out there looking for Ukrainian companies. I don't know. So make sure that you are doing your research if you really are pitching to an investor who is going to give you money. Number 4, partnerships. This is very, very important. I think it's one of the most valuable tricks that is least used. Surprisingly, I did hear that a lot in the pitches here today, which is great. I'm good that you guys are thinking about that. But partnerships being that lots of people want to just get information out there. That's almost like paying for advertising, marketing. And so partnership is a good way to get your name out there where you're sharing revenue. It could be a 20-80 relationship, it could be a 50-50 relationship, but it is additional revenue at the end of the day. And so if you're struggling to generate revenue because it's costing you far too much to market to a particular audience, you can partner. In fact, there's a fintech company I invested in, and they partnered with Sky. I said, what have you got to do with Sky? They said, well, I get access to all the Sky customers by basically partnering with them. It is an additional revenue I don't have to work that hard for because my cost to get that customer is almost minimal compared to just my operating cost. Number 5, do your research, and that's on the business side of things. Follow the trend, right? Now, there is, for example, nowadays a lot of hype about artificial intelligence. You want to know what the market is doing. You want to know what differentiates you. I'm not saying everybody starts including artificial intelligence in their pitch decks, because that also happens. I mean, I'll share one of these. This is a few years ago. This startup came to me and they said, we are a blockchain platform using NFTs and crypto to use artificial intelligence and make it sustainable, ESG compliant, diversity and equity. Exactly. There we go. Every single thing in that one company. And I knew that was like, okay, you're basically just using buzzwords. So don't use just buzzwords. Know your market, know how it's applicable, know where it's not applicable. You don't want to waste a lot of money trying to include technology in your investment if it's not applicable. You are a startup. Be nimble, be quick to adapt. You have that advantage. Large corporations or any corporation which is of a reasonable size, more than 100 people, they will not have that because it will take them time to write processes, and you as a small firm of 5 people can easily do that. That is your advantage. That is how many small firms have been able to disrupt really large firms because they've been quick to adapt. And then final bullet, which I think is the most important bullet, around share your planning for the next round. right? So if somebody's asking me some money, I want to know when I can go out. Because as much as I, love hearing presentations and, I care about the environment and I care about everybody in the world, I want to know when will I get my money back, and more importantly, when I can multiply that money. And your planning for the next round or exit strategy, you don't have to execute it, but you can show the pathway to say, yes, I have thought about the next round. Yes, I've thought about the exit strategy. I think something Rishi highlighted as well. So those are the 5 things, at least from my perspective, in this challenging environment. I think if people were to adopt in their fundraising, in the way they operate their business, should hopefully help you secure some funding. And finally, I will take a couple of questions if there are any. Hopefully somebody has one burning question at least. There we go. The message was too important, too clear. But I'll be around, more than happy to chat afterwards if you have any questions. I hope this was useful and did wake you up a little bit. Thank you.